This is an emergency broadcast. I need you to stop what you're doing immediately. Put down your phone, turn off the television, and listen to me very carefully because the world you thought you lived in yesterday no longer exists. The financial reality of the last 50 years has just been deleted. The static image you're seeing on the silver chart, that flat horizontal line sitting at exactly $126.50, is not a glitch. It is not a mistake. It is a tombstone. The event we have spent years preparing for here at the Money Code, the event the mainstream media said was impossible, the event the bankers prayed would never happen, has just happened. The United States futures market has officially suffered a catastrophic mechanical failure. We are currently in a state of limit up. Trading on the COMEX has been halted. The buy button is jammed, the sell button is gone, and the price is frozen in time. Ladies and gentlemen, welcome to the Money Code. If you're watching this, you are the resistance. You are the survivors. Because as of 9:30 a.m. Eastern Standard Time this morning, the paper game is officially over. The casino has turned off the lights because the house has run out of chips. We need to dissect exactly what just happened in the last few hours because the financial networks, the usual suspects who lie to you for a living, are not going to tell you the truth. They're going to tell you it is a volatility pause. They're going to tell you it is a technical cooling off period to protect investors. They are lying. This is not a cooling off period. This is a seizure. The heart of the Western financial system has stopped beating and the patient is on the table screaming. Let's look at the data. Let's look at the crime scene. In the last 24 hours, we watched the retail banking system begin to fracture. We saw the suspension of sales at major bullion desks. We told you that was the first domino. We told you that once the retail window closed, the panic would move upstream to the exchange itself. And this morning, that is exactly what happened. At the open, silver didn't just rally, it didn't just climb, it gapped. It opened significantly higher, and within 3 minutes, it hit the exchange-mandated ceiling of $126.50. For those of you who don't study the obscure rulebooks of the CME group, let me explain what limit up means. The exchange has a specific rule, Rule 589, designed to prevent panic. It says that a commodity cannot move more than a certain dollar amount in a single day. They built this rule to stop a crash. They built it to stop the price from falling to zero during a depression. But they never expected, in their arrogance, they never calculated, that they would need to use it to stop the price from going to infinity. The limit for today was hit in seconds. And now, nobody can trade. If you want to buy silver for 127s, you can't. The computer won't let you. If you want to sell silver for 126.50, you can, but nobody is selling. That is the key. The market is locked because there are millions of buyers at the limit price and zero sellers. This is a no-offer market. That is a term that should send shivers down the spine of every banker in London and New York. It means that at the official price of $126.50, there is not a single ounce of silver available for sale in the entire futures network. The sellers have gone on strike. They have looked at the inflation. They have looked at the dying currency. And they have said, no, my silver is worth more than your paper limit. This is the moment where the price on the screen becomes completely detached from reality. The price on the screen is $126.50. But the real price? The price to actually get metal? It is a ghost. It doesn't exist. I have been on the phone all morning with sources inside the clearinghouses. These are the guys who settle the trades. These are the guys who see the flow before it hits the tape. And what they are telling me is terrifying. They're saying that the order book is not just unbalanced, it is broken. Usually, for every buyer, there is a seller. That is how a market works. Today, the ratio of buy orders to sell orders at the limit price is 500 to 1. There are hedge funds, pension funds, and desperate industrial companies piling into the queue, begging to pay the limit price, and the other side of the ledger is blank. It is empty. This is why the trading is halted. The algorithm doesn't know what to do. The computer program that runs the world economy cannot process a variable where supply equals zero, so it crashed. It just stopped. And now we wait. We wait for the exchange to expand the limits. Usually they will widen the bands tomorrow. They might allow the price to go higher. But here is the trap. Here is the nightmare scenario that nobody is talking about. What if nobody sells at the new limit? What if nobody sells at 140? What if nobody sells at 160? We are facing a phenomenon called limit lock. This happened in the nickel market and the palladium market years ago, but never like this. Never in the most strategic metal on Earth. If the market stays locked limit up for 3 days, the exchange has the power to declare a force majeure. This is the phrase I need you to memorize. Force majeure. It is the legal escape hatch for the criminals. It means unavoidable accident. It allows the exchange to say, no, we cannot deliver the silver because of circumstances beyond our control. And when they declare that, they will invoke the cash settlement clause. Listen to me very carefully. If you hold a futures contract right now, thinking you're rich because silver is at $126, you are in the danger zone. The exchange is preparing to force you to accept cash instead of metal. They are going to print worthless fiat currency, deposit it in your account, and cancel your contract. They will say, here's your $126, go away. But you can't go away. You can't take that $126 and buy silver because there is no silver. You will be left holding a bag of burning paper, while the real asset teleports to a dimension you cannot access. This is the ultimate rug pull. This is the moment the paper promise is revealed to be a lie. This is why we stack physical. This is why we warned you at $30, at $50, at $80. The paper market is a simulation, and today the simulation froze. The matrix just blue screened. But while New York is frozen, while the American traders are staring at a halted screen, the rest of the world is moving on. We need to talk about the spread. We need to talk about the divergence that proves the system is dead. Because while the COMEX is stuck at $126, the Asian markets are still open. And do you know what the price is in the East right now? I just checked the feed. It is trading freely at the equivalent of significantly higher prices. The gap is massive. Do the math. That is a massive arbitrage opportunity. In a normal world, traders would buy in New York at the halted price and sell in Asia and make a fortune. But they can't, because the New York market is halted. You cannot buy. The bridge is burned. The West is trapped in a frozen price while the East discovers the true price. This gap is the death warrant for the Western dominance of pricing. It signifies that the Western pricing mechanism is no longer relevant. The world doesn't care what the COMEX says anymore. If the COMEX says $126 and the real physical market says $150, the price is $150. The COMEX has become a museum of old prices. And it is not just the price that is breaking. It is the trust. My sources at the major bullion banks, the big players like JP Morgan and Citigroup, are telling me that the phones on the institutional desks are silent. Not because nobody is calling, but because the traders have stopped picking up. They are terrified. They have clients screaming for delivery. They have industrial clients, the people who make electronics, missiles, and solar panels, screaming, where's my metal? I have a contract. And the bankers have to tell them, the market is halted. We cannot source the metal. This is the supply chain collapse we predicted here at the Money Code. When the price goes limit up, it means the supply chain has snapped. It means that from this moment forward, if you are an industrial user of silver and you do not already have it in your warehouse, you're out of business. You are done. You cannot buy it on the exchange. You cannot buy it from the refiner because the refiner is sold out. This is going to trigger a wave of manufacturing shutdowns by the end of the week. Watch the news for supply chain disruptions in the tech sector. That is code for we ran out of silver. But let's go deeper. Let's talk about who is really behind this halt. Why did the selling stop so abruptly? Why did the shorts finally give up? Because they ran out of collateral. The banks that usually short the market to keep the price down, they need to put up margin. They need to put up cash to back their bets. With silver gaping up overnight, the margin requirements exploded. We are talking about billions of dollars in calls due this morning. I believe, and this is my analysis based on the flow, that a major player failed to meet the margin call this morning. One of the big shorts blew up. They couldn't post the cash. When a big player defaults, the clearinghouse has to step in and liquidate their position. That means the clearinghouse has to buy back the short position. But there are no sellers. So the clearinghouse itself became the desperate buyer that drove the price to the limit. We are watching a liquidation event. The limit up is the sound of a whale dying. So what happens tomorrow? What happens when the sun rises on the next trading session? There are two scenarios. Scenario A, the exchange reopens with expanded limits. They raise the cap to $150. The market opens, gaps instantly to $150 and locks limit up again. This creates a multi-day freeze. This is the nickel scenario from a few years ago, where the exchange had to cancel trades to save the tycoons. If they do this, if they cancel trades or freeze the price for days, it is the end of the credibility of the exchange. Confidence will evaporate to zero. Scenario B, they declare force majeure immediately. They force settle everyone in cash. They say, the market is closed indefinitely. Here's your check. If they do this, the physical price on the street, the price you pay at a coin shop or in a private deal, will double overnight. Because suddenly the only silver available is the silver in your hand. The paper derivatives will be exposed as worthless betting slips. Either way, the result for you, the physical owner, is the same. The price is not 126. The price is no offer. The price is priceless. I need you to understand the psychology of what you're seeing. When a market halts, it creates panic, but it also creates clarity. For 50 years, they told us silver was abundant. For 50 years, they told us the price was determined by men in suits in London. Today, the market proved them wrong. The market proved that at $126, there is no silver. That means the fair value is much, much higher. If you're holding physical silver, do not sell. I repeat, do not sell. I know $126 sounds like a lot of money. I know you're looking at your stack and thinking, I could pay off the house. I could buy a new car. Do not do it. You're trading a scarce strategic asset for a currency that is currently failing. The very fact that the market is halted proves that the currency is losing its ability to command resources. If you sell your silver for $126, you are buying into the burning building just as the fire trucks are leaving. The people who sell today are the people who will regret it for the rest of their lives. We are looking at a repricing event. We are looking at silver moving from a commodity to a monetary asset. When this halt lifts, or when the black market takes over, we are not going to see 130. We are going to see 200. We are going to see numbers that look like typos. You have to realize that this halt is protecting the banks, not you. The halt is designed to give the insiders time to figure out a way to screw the retail investor. They are currently in a room somewhere in Washington or New York, frantically trying to change the rules. They are trying to figure out how to settle these contracts without bankrupting the entire banking sector. And the only way they can do that is by capping the price or changing the settlement terms. They will try to cheat. They always try to cheat. But they cannot cheat physics. They cannot cheat supply and demand. The metal is gone. This brings us to the most important point of this broadcast. What do you do with your cash right now? If you have money sitting in a brokerage account waiting to buy the dip, you need to understand that there is no dip coming. The dip is a myth. The dip is gone. The train has left the station and the tracks have been blown up behind it. If you want to get exposure to silver now, you have to go into the wild. You have to find the physical metal in the secondary market, and you have to be willing to pay whatever the seller asks. We are seeing reports of premiums exploding. Online dealers are pulling their inventory. Local shops are closing their doors because they don't know how to price their items. How do you price a silver eagle when the futures market is broken? You don't. You hold it. You wait for the dust to settle. We are entering a period of price discovery that will be violent and messy. And consider the silence from the government. Have you heard a statement from the Treasury? Have you heard from the Federal Reserve? No. Silence. Because they know they can't fix this. They can print dollars, but they cannot print silver. They can bail out a bank, but they cannot bail out a shortage. They are watching the same screen we are, the gray screen of death, and they are realizing that their control is gone. The power has shifted. The power is now in the hands of the holder. If you hold the metal, you are the central bank now. You decide the price. And if the exchange won't let you trade, you will find a market that will. So, what is your marching order for today? Sit tight, watch the show. This is the collapse of the paper manipulation scheme in real time. It is ugly, it is violent, and it is terrifying for the uneducated. But for you, for the Money Code family, this is victory. This is the validation of every ounce you bought, every premium you paid, every time you were laughed at for buying rocks. The rocks just broke the machine. The limit up at $126 is just the beginning. The shorts are dead. The paper market is dying. The physical reality is here. Stay liquid. Stay stacked. And do not let go of your metal for paper promises. The next trade won't be on the COMEX. It will be in the real world. This is the Money Code. The system has failed. The price is real. I will see you on the other side of the halt. Pulled hard.